Nobody gets into real estate investing to talk about what could go wrong. But here's what I know from experience. The investors who thrive are the ones who paid attention and accounted for risks up front. So let's talk about what could happen so you can be prepared as well. The 6 categories of risk you need to understand before you buy your first or next investment property are market risks, property management challenges, regulatory risks, human factor risks, financing risks, and technological disruption. Before we dive in, download my cheat sheet below for avoiding each. Now let's get to it. First, market and economic risks. When the broader economy shifts, your property's value and your rental income can shift right along with it. Think about what happened during 2008 or the pandemic. Prices swung wildly, or think about recent supply chain disruptions and tariffs that sent construction and renovation costs through the roof. Here's the key takeaway. Create a buffer when you buy and think long-term. Market cycles are normal. Your job is to be financially prepared to ride them out. Next, property management. Finding reliable tenants is sometimes harder than it should be, and maintenance costs add up fast. Then there are things completely outside your control, like a natural disaster or a major repair hitting at the worst possible time. If your deal only works when everything goes perfectly, it's not a good deal. Hope for the best, but prepare for the worst. Now let's talk about regulatory and policy risks. This one trips a lot of investors up. Governments change the rules all the time. For example, zoning laws, rental policy updates, foreign buyer bans, etc. So it's important to stay current on local, provincial, and federal regulations. To do this, you can create a task in your favorite LLM, like ChatGPT or Claude, to keep track and notify you of changes weekly or monthly. Also, build relationships with people who track these things, like realtors, mortgage brokers, real estate lawyers, property managers, and accountants, so you can get the info you need to make changes faster. Next up, human factor risks, aka people risk. Whether it's a joint venture partner who doesn't pull their weight, a guru selling you advice they've never actually tested, a seller hiding problems with a property, or a contractor who ghosts you mid-renovation, the humans in this business can cost you just as much as any market downturn. Do your due diligence, check references, and build a network of professionals you actually trust. Now for financing risks. Here's something I struggled with, and many of you might have too. The interest rate decline and then spike between 2020 and 2025. If you had a variable mortgage, you definitely felt it, and not in the good way. The fact is, interest rates move, and accessing equity gets harder in downturns. If you've stretched yourself too thin and are over-leveraged, a few bad months can sink you. To prepare for this, talk to your lender about a home equity line of credit before you need it. You might never use it, but having it in your back pocket can be the difference between surviving a rough patch and being forced to sell at the worst possible time. And lastly, technological disruption. Remote work has permanently shifted where people want to live and work, and the AI landscape is changing daily. Stay informed and adapt early. The investors who embrace tech, like online platforms for landlords to manage their properties or using AI tools to analyze deals faster, are going to have a serious edge. So there you have it, the 6 categories of risk. You now know more than many people who've already bought their first property. Awareness is step 1. Step 2 is building your strategy around that awareness so that when these challenges show up, you're already prepared.